Hey. Hey. Number 200. Hey. Number 200. Huh? Trying to look pretty for you. What do you think? Yeah, got the cufflinks on again. Got the dollar out. All right, let's get on with it. We got lots of work to do today. FXStreet. Yeah. Welcome to FXStreet. Trade non-farm payrolls live. This is the 200th month in a row of doing this webinar with FXStreet. This is a collab between FX Bootcamp and FXStreet. We've been working together nearly 20 years now. How about that? Well, let me remind you that trading is risky. It's not appropriate for everyone. Your past performance, good or bad, doesn't necessarily predict future results. Therefore, always be small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonell. Been trading for about 20 years. And in my 40s, I went to Harvard and got 2 degrees. One of them is a 4-year degree in macroeconomics, which I love. I was also a Silicon Valley venture capitalist, having done over 100 deals. Also helped other startups raise money, millions of dollars from other VCs. I worked at little tiny companies in Silicon Valley called Apple Computers, Cisco Systems, and NASA. You're like, NASA? Yeah, they used to put rockets in the sky. Remember that? You mean SpaceX? No! And then, the guy that broke the Bank of England, George Soros. I sat on a board of directors with him. Yeah, how interesting is that? So I've done a few things and a few other things. I used to have a paper route too, and I worked at hockey games. So cool. Very cool. So anyways, I bring some baggage to to our relationship. That's what it is. Bottom line is I'm a macroeconomic trend trader. Macroeconomic trend trader. That means I look at the fundamentals first, and then I go to my charts. Arturo says, hey, is this going to be recorded? Yeah. Yep, but only for you. Yeah, this will be recorded. Oh, faux show. Got a lot that I want to cover today. One of the things I thought I would do is I found the original slide deck. Now it's been converted into like Google Slides and Office Slides and some bunch of other slides. So a lot of the animations don't work anymore. But this is the disclaimer from Non-Farm Payrolls number 1. Interesting. So I thought I'd cover some of this because it still makes sense. Now, we have a mantra at boot camp. Oh, come on. How do you do it on this one? Set up slideshow. There we go. That's probably what we want. Okay. This goes back a long time. So imagine 16 and a half years ago on Non-Farm Payrolls Live number 1, one One of the first things I discussed is that the number one goal, according to the FX Bootcamp mantra, is capital preservation. Now this will help you understand how I trade and really who I am. The number one goal is to not lose money. I don't believe the right goal is to try to make money. Of course, that inevitably is your job. But your number one goal is to preserve your capital. See, your capital is your product. It's your service. You need capital to trade. So you have to go through the mindset of living to trade another day. Another way of saying this is you don't need to make a lot of money today. You don't need to make a lot of money today. You don't need to make a lot of money today. Because reward is a function of risk. And so for you to make a lot of money today, you need to take risk. Risk is bad. Now, did you guys read the interview that I did with FXStreet last week during the Thanksgiving holidays? While my mother was hanging out with my wife and my kids, and I was outside actually writing an article. Yeah. Hey, it takes time. Someone had to do it. I had to do it. The other thing it says in that article, the other thing I say is bad is volatility. So the two worst things that you can run into as a trader is you're jacking up risk so you can try to make a lot of money. Risk is bad. Okay? Making a lot of money quickly is probably the worst strategy you could possibly do, and you're virtually guaranteed to destroy your trading account. Okay? The only people that gamble big like that are people that have nothing to lose. If you ain't got no money anyways, might as well gamble it all. But the thing is, even if you are right 2, 3, 4 times in a row and suddenly you've gone from no money to a lot of money, guess what happens? You blow it up and you lose it all anyways. So whatever, it's not the point. The other thing that's bad is volatility. Guess what non-farm payrolls is? Volatility. And volatility is bad. So I'm going to teach you how to incorporate non-farm payrolls into your macroeconomic bias. And you don't need the volatility to make money. You don't need volatility to get rich quick. In fact, volatility and risk combined on the long run will get you poor quick. So we'll talk about that. By the way, how many people here agree with that assessment? High risk is bad. High volatility is bad to your long-term trading results. Yeah. You don't need it. Now, the next thing is capital acquisition. The second mantra is it's about risk management, really. When you take a trade, there needs to be a certain potential reward, not based on risk, but by the probability of the value of the trade. Is this trade worth 30 pips or 300 pips? Well, if you can't figure that out, you don't have a trading strategy. You don't have a trading plan. And so there has to be a certain level of risk reward that you take. So let's say you think it's worth 300 pips. Maybe you could have a 100 pip stop on that. You're like, 100 pip stop? That's crazy. Lower your lot size, aka reduce your risk. And then along the way, you reduce the risk by moving your stop. Once you're up 50 pips, you move your stop a little closer. Now you're up 100 pips, move your stop to break even. And you can lock in a minimal acceptable performance Back when I wrote my book in 2008, what I suggested is you lock in 15 pips a day. And really, you should do that on the weekend. Okay? So imagine on the weekend, you move your stop and lock in somewhere between 50 and 100 pips on your open positions per trade. And then you let it run. And that's the whole point. Move your stop. Not necessarily take profit, move your stop. And that's what capital appreciation is. Okay? Let your winners run. I am convinced, and I have been for all 20 years of my trading. In Non-Farm Payrolls number 1, I gave you the same advice. Keep your losers small. Let your winners run. So that's 16 and a half years, 200 months in a row. I've given the same advice because this mantra is the way of life of a currency trader that can survive. It is the way. For those that have not traded with me before, look at it. Wow, all the fonts have been distorted over the years. Anyways, take a screenshot. Those are my settings. I'll explain these setups, and then we'll get into the market. First thing I do is I look at the 2155, tells me the speed and the direction of the market. I look at this. The 21 is below the 55. This market is bearish. I'm done. I don't need any more information. But no. 21 is below the 55. I'm a bear. Now, momentum has to do with the 5/8. Momentum is price. Speed is market. The market. This is a bearish market. Do I buy in bearish markets? No, I do not. I sell in bearish markets. So I want to look for things like 5/8 crosses to put me short, 5/8 crosses up to get me out. That's it. And then along the way, using these moving averages, re-enter based on the 5/8 cross. What does all this mean? What did I say in Non-Farm Payrolls number 1 200 months ago? If the market is bearish, I want to sell. Oh my God. Give this kid a Nobel Prize. That is genius. Well, girl, you know it's true. That's how you're supposed to trade. Oh, but it's difficult, isn't it? Wait, if the market's bearish, sell. If the market's bullish, buy. Keep your losses small, let your winners run. Okay? Well, simple enough. So why do we make it more complicated than that? Well, the goal is not to make it that complicated. You could use Bollinger Bands, by the way. It's really sort of a measure of volatility. Oscillators we can cover. I slow the MACD down to show me overbought and oversold conditions for the market. I speed stochastics up to show me overbought and oversold conditions of price. And everything I do, whether it's moving averages, oscillators, drawing support and resistance on price, and or drawing pivot points of support and resistance of market. What I do over and over and over again using different methodologies is separate market from price, market from price, market from price. The reason for it is the first question always is, what are the market conditions? Bullish or bearish? Bearish. Good, I want to look to sell. Then I look at the next set of indicators and tools. Is this a good time to sell? Yes or no? No. Then I wait. And at some point, I know I want to sell. So now, all I need to figure out is what price and what time. But that's what technical analysis is. On the bottom, you have time. On the right, there's price. So I'm like, I want to sell, I want to sell, I want to sell. Why? The market's bearish. At what price do I want to sell? And at what time? Oh, good. That's just technical analysis. That's not complicated. How many people here find technical analysis complicated? Is your technical analysis skills holding you back from the destiny you believe you deserve? I bet you it's not. I bet you if you've been trading for a while, you know you're good enough. You're smart enough. Gosh darn it, people like you. Okay? No, but I'm talking about, Alex, your internal compass says, I think I should be better. I should be more profitable than I am. It's kind of right. You know what I mean? So anyways, there's more to it than all of that. We can get into the news scalp, but this I'm just showing you, this is the actual slide deck from Trade Non-Farm Payrolls Live number 1. Okay? Alex's steady performance is what you should be after. Yes, the way I describe that is low volatility and consistent returns. So you want like a Sharpe ratio of 1.5 or better. And if you're like, Wayne, what the heck is a Sharpe ratio? We can talk about risk-adjusted performance later if you want. See, look, I've been doing this a long time. I've done a lot of things. I've learned a few things, and I'm here to share. So if you want to talk about risk-adjusted performance analysis, let's do it, Bubba. Okay? So I'll let you guys lead the way if that's okay. And also, if you don't mind, we'll do this live stream for maybe as long as 3 hours today, which would give us a lot of opportunity to discuss whatever you want to talk about. Oh, I moved this, right? No, that's got to be here. There we go. Crazy Tanga says, NFP, buy or sell? I don't think you should be trading. That's my advice to you, Crazy Targa. If you ask a question like that, you should not trade. But I doubt you're going to listen to me anyway. So, but let's talk about non-farm payrolls. Is it going to be good or is it going to be bad? Oh, you think it's a buy? Great. Don't care. Show me your analysis, and I'll consider it. Okay? 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 Some people think it's going to be good. Some people think it's going to be bad. It's irrelevant. It's irrelevant. Okay? But I can tell you the market reaction. But look, the Fed has already made a decision that they're only going to raise interest rates by 50 basis points, right? On the 14th of December. Well, what about non-farm payrolls? Look, it's done. They've already decided. Who cares? You're like, well, maybe non-farm payrolls is going to change the terminal rate. Look, dude, I don't think they even know the terminal rate. I know it's priced in. I think people pricing it in are wrong. I think they're basing their analysis on hope. So look, honestly, we're going to get volatility. It's not going to change Fed policy. It's not going to change the economic conditions of the United States of America. But I'll tell you what it will do. It will add volatility. And here's the thing. Good news today will be bad, and bad news today will be good. Okay? Okay. 50 basis point hike. Yes, there's a 77% chance of that, RCK. But dude, did you not watch the Powell presentation when he said it's an appropriate time? Like, these things are virtually facts. Like, Powell said they're probably only going to raise by 50 basis points. If you look at the Fed funds futures market, it's already priced in. That's what I'm saying. It's done. It's done. Well, what about NFP? They already decided. Okay? But the gold is going up. It's supposed to be going up. We'll cover that. We'll cover that. We'll cover that today. There's a lot that we can cover today. Okay? Well, you can see here on this particular setup, pretty basic price action moves here. Oh, let's do this in a different color. La, 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 la. Okay, now we're in, right? We've been in sideways mode for a while. And now we breach to the upside, and we're probably going to do some form of this for a bit. Okay? Alex says you have to plan it hours in advance. Okay? I'm selling Euro USD in January. So I can plan this out months in advance. It's okay. But I knew that not just today. I knew that, let's say, July 1st, Canada Day, the greatest day of the year. If you asked me what I was going to do in January, I'd say, oh, I'm going to sell the euro dollar. I'm going to sell the pound dollar. Oh, cool. So I'm thinking even more than hours ahead. I'm thinking days, weeks, months. I'm even thinking about 2024, 2025. Okay? So let's talk about this. If the news is good, what do you think? 265,000 jobs? Would that be good? Good news would then be interpreted by market participants that the Fed rate hikes are not working yet. Inflation will be persistent because wages will be high. Therefore, the Fed will, even though they're slowing down the pace of rate hikes, they will have to continue raising further. And what would need to be priced in is not 4.75 or 5.0, but 5.25. So good results will lead to a strong dollar, and that's bad. So a good headline number today. Evan says 300. Okay, it comes out 300,000. That's bad news because it's good. Dollar will probably get strong. Let's flip it around. The number comes out bad, 120,000. That's bad. Probably because of things like layoffs and a bunch of other things. So that's bad, which means the cumulative effects of Fed policy over time. Okay? Why would I say it that way? That's the exact words Jerome Powell used during the last FOMC press conference. You see, all this information is available. You just have to do the work. And he said, look, the things we've done will take time. If you're an economist, you already know that it takes 6 months or longer to see the effects of the Fed raising interest rates. So we're just starting to see the effects of what the Fed was doing in January. So anyways, let's just say non-farm payrolls comes out 120. Oh my God, that's bad. hey, everything the Fed is doing is working. Yeah. And not only are they going to slow down the pace, maybe they'll pause quickly. Maybe the terminal rate is low. Maybe it's only 4.25 instead of 5.25. Oh my God, that's so good. And the bad news is good news. The dollar rallies, the stock market rallies because the end is near. The worst is over. The medicine was bitter, but now we're going to survive and go back to normal. Everything's right as rain. Stock market up, dollar down, gold up, Bitcoin up. Can you see the behavioral finance in there? Good news is bad, and bad news is good. This is why traders that say, oh, 300,000, buy, lose money. Because they just think a high number is good and a low number is bad. Son, it's a little more complicated than that. Now, what we really care is about the policy of the Fed. And right now, what the market cares about, what institutional investors care about, is the terminal rate. And that is in flux. That's fluid. That even changed a lot after Powell's speech to the Brookings Institute. Was it yesterday? I don't know. So, no, I guess the day before? Oh my God. It's hard to keep track of days. But anyways, that changed a lot because he told us information like he's only going to raise 50 basis points. Okay. Alex says it depends on what asset you're buying. No, it does not. But you do what you are saying, and I will agree with that. What you are saying is different assets have different relationships. Yes. But I have a Newtonian physics point of view of global macroeconomics, which means a good number is bad, terminal rate is higher, dollar gets strong, gold falls, oil will probably fall, okay? Bitcoin comes down, so on and so forth. And it's all the same thing. Okay? The question for me is, do the whales know the NFP number before it's released? No, they don't. But if you're listening to a guru on YouTube that is giving you that kind of information and advice, please listen to me, and I'm being very serious. Stop listening to them. Okay? Okay? Honestly. Okay. Cool. Alex says the banks do. No, they don't. But here's what I'm telling you. And it doesn't matter if they did. What I'm trying to teach you is that there are long-term trends. The headline non-farm payrolls number today is actually irrelevant to the current Fed policy. And the current Fed policy is what's dictating the value of currencies in our market. So what we should be looking at is like wages. Okay, so the headline number will create the volatility. Volatility for dollar strength or volatility for dollar weakness, or God forbid, both. But the volatility is irrelevant. That's for retail. Okay? Institutional investors have already decided, do they want to sell high or do they want to buy low? The volatility is just going to create the opportunity. Okay? So an institutional trader would do something like this. They already decided this yesterday. They're like, yeah, we might buy some here and we might buy some here. And now they're done. That's it. Why? Because they believe the dollar's going to weaken between today and sometime in the future. And seasonality would dictate that this should go up until about the third week of December. And that's how an institution plays non-farm payrolls. If it comes down, they want to buy it. They're not chasing it around. Oh my God, look at the big green candle. That's not how institutional investors trade. Come on. You know that. You know it. And if you don't know it, you must feel it. You're like Neo in the back seat of the car looking down the dark, rainy street. You know, right? You know that there's some truth missing. And that's what I will teach you. I promise you that. Okay? Oh, thanks, Chirag. Yeah. I don't know. Kind of look like Alex P. Keaton. I know. Okay? So anyways, let me get rid of that before. But that's how you do it, right? That's how you do it. So they're not chasing price. It's just like they decided if the market comes back and it doesn't make a lower low, okay, they want out. So what matters to a market participant would be they see this here as a low, they see this as a low, there's a fractal low, here's a fractal low, here's a fractal low, here's a fractal low. So they're like, okay, ladies and germs, if euro dollar drops below there, we're no longer bullish on this pair. Dude, that's not that complicated. Okay? Institutional investors are not gods. Yes, they might have a better education. Yes, they might have more money. Yes, they might have a research department. But you're supposed to be trading the same way. And it's actually not that complicated. You could flip a coin. You could just flip a coin. There's your research department. By the way, would you like a research department? What are the best ones to be trading right now? Oh, these are all the buys. These are all the neutrals. There's all the sells and strong sells. Huh? Quantitatively analyzed. Okay. Alex says, I think it can confuse your bias. What, flipping a coin? No, here's what I mean. You don't flip a coin on a pair. You flip a coin on the reserve currency. You're a bull or a bear. Done. I swear to you. Okay? If you did something like that, you would have to change the way you trade. But if all you did in 2023, okay, we're talking next year now. If all you did was, let's say, buy the dollar. That's your bias, let's say. You flipped a coin, you're going to buy the dollar for the year. That means you have to be patient and disciplined enough on euro dollar to only sell lower highs. And if it makes higher highs, you stop trading. Do you understand you will be consistent? And if you sell lower highs, you'll almost, I can't say almost always, you will probably be profitable because now you're only selling lower highs, which is the definition of a downtrend. So you only sold pound dollar on lower highs. You only sold euro dollar on lower highs. You only sold Aussie dollar at lower highs. You only sold Kiwi at lower highs. You only sold gold at lower highs. Do you understand? You will likely be more profitable if that's what you did versus what you're doing now. You'd have to be patient. You'd have to be disciplined. But when you traded, you were probably going to be right. But look how low your volatility would be. Your Sharpe ratio would be amazing. And now you would actually have results like a professional trader. Because you essentially have a fundamental bias that you're trading technically. Done. You've made it. Okay? Okay? So we have questions here. What do I think about gold? Okay, well, you're going to have to take, right? Right now, gold is bullish. And it'll be bullish probably till the end of the month. Hang on, I lost my quant box. Okay. Okay, what do I think about gold? That's what I think about gold. Okay, it has a pretty decent score. So when you look at GDP, inflation, employment, interest rates, dollar positioning by retail, dollar and gold positioning by institutions, seasonality on the 5-year and 20-year averages, and technical analysis, it's a buy. Okay? But check this out. The reason I said I'll probably be selling, like, why would it go up till the end of the month? Because over the last 5 years and over the last 20 years, gold comes down in January and February. But I already told you I'll be buying dollar. I already told you all this. I already have it planned. Mike wants me to look at Rand. Rand is a disaster. Okay? Rand is a disaster. But I think we'll just get back to normal. Apparently, senior government officials in South Africa were stealing money from the good people, the good citizens of the country. In many other places in the world, that would be shocking. And I think probably the vast majority of citizens in South Africa just kind of shrug their shoulders going, yep. It's not barely even news. So we'll get back to reality probably pretty soon. Also, I believe those investors that were lending South Africa money, they're doing it simply for the high yield, and they'll get right back to that. Okay? What about Bitcoin? If dollar's strong, sell it. If dollar's weak, buy it. Sir, your background statue, where? Oh, what, the bull and the pig? The bull fell down, so the market must be bearish. Sir, how do you see the Dixie by the end of the year? Well, again, I just explained that, Florin. Okay, based on seasonality, dollar typically is weak. Okay, so probably be weak for another 15 to 20 days. Okay. What other currency pair do you want to look at fundamentally or quantitatively? Euro dollar? Sure. Okay. By the way, notice that I'm on the Google Cloud. This is not a website. I'm not serving you images. I'm in the Google Cloud and the algo, the AI is crunching the data, you're actually looking at the math in real time. Okay? So look, euro dollar's neutral. Why? Most economic data, okay, like non-farm payrolls, for example, when you look at interest rates, unemployment, inflation, GDP, technical trends, seasonality, retail positioning, institutional positioning, and you quantitatively add them all up, most things right now favor the US dollar, except for seasonality. Seasonality tells you, despite euro dollar, right? Despite the fact euro dollar should be falling, should is a big in quotes, it usually doesn't this time of year. That's seasonality. That's a leading indicator, a predictor of what usually happens. And what usually happens is this time of year, euro dollar goes up despite the long-term fundamentals. And it did. And you see that technically. So seasonality says, yeah, it typically goes up this time of year. And trend confirms it. Oh, yeah, it's going up. Good. So don't sell. Okay? Don't sell a rising market, right? Think of this. I said, determine if a market is bearish. And if it's bearish, you only sell lower highs. So in a way, you could say, fundamentally speaking, this is a bearish market. But it's not technically bearish, so you're neutral. But by gosh, when this technically goes from bullish to bearish, that's when you fire for effect and you let your winners run. So it's a sell, just not today, Bubba. Pound. Okay. Okay, COT data, this is institutional sentiment, or not sentiment really, it's positioning. Institutional positioning, okay, is very short the pound. Retail's very short. But it's going up. What tells me is there's lots of profit taking. Okay, interest rates favor the US dollar. Unemployment favors the UK. Inflation favors the United States. Growth favors the United States. But it's a bullish trend favoring the pound. Seasonality favors the pound. Why? Because this time of year, the dollar weakens. But look, we already know all of this. You should have known this weeks and months ago. Where were you at the last non-farm payrolls? So here's what usually happens. And then, guess what? January and February and March, if technical analysis turns bearish, I'm going to sell, and I'm going to hold short, and I'm going to let my winners run. So currently, I'm neutral. Isn't that nice? So what actually works well? You're like, Wayne, is everything neutral? No. Right? Kiwi CAD is a strong buy. Oh, well, let's go look at that. Let me go to my cross pairs. Take a look at Kiwi CAD. And you've known this for weeks. Okay, check this out. Retail is short. Retail's short. Retail's short. Do you feel bad? You feel bad? Retail is short. Oy vey. That sucks. Well, anyways, look, it's going up. Look, September, October, November, December, this goes up, and it is going up. The only thing Canada's winning on is inflation. Canadian inflation is 6.9. Inflation in New Zealand is 7.2. But New Zealand is is winning in everything else. It has a great, strong score. The only thing is institutional investors are not even in it yet. Oh my God. Look at COT data. Flat. Retail short. Okay, so retail's heavily wrong, and institutions are not so sure. At least they're not putting money towards their opinion. But nonetheless, this has been working for a while, and you probably should have known this for weeks. Now, that's the problem, though, because you need to look at interest rates, unemployment, inflation, GDP, technical trends, seasonality, retail positioning, institutional positioning for every currency and asset class in the world, comparing them both in real time, and then creating a trading bias. That's a lot of work. My algorithm does it automatically. It gathers all the information and does it all automatically. So all you have to do is go like, all right, what do I want to do? What do I want to look at today? I don't know. Let's look. How about Euro Kiwi sell? What about pound Kiwi sell? What about Aussie Kiwi sell? Oh, okay. Maybe take a look at oil. Okay. And now you just you sifted through 30 asset classes in a matter of seconds. Remember, it's not just fundamental. It's positioning, right? Positioning, retail and institutional positioning. It's seasonality. Isn't that beautiful? Beautiful. Anyways, we'll get to that in a bit. Why is $0 over the counter not transparent and euro-dollar future is transparent? I'm not sure what you mean by that. Cool. Hope said the Kiwi CAD trade 3 days ago was stellar. You're still in it? Good job, Hope. Okay. Quickly take a look around the world, see what's moving. Oil's doing well. Kiwi CAD's doing well. Kiwi dollar's doing well. DAX is doing well. Looks like everybody's just selling CAD, huh? Pound CAD is a winner. Euro CAD is a winner. Okay. Nikkei is down. Rand trying to rebound back, huh? That's interesting. Maybe we will look at that again. Okay, check this out. CAD yen down. USD yen down. Aussie yen down. Euro yen down. Pound yen down. Swissy yen down. Hey, do you think the yen is strong today? Okay. Alex says, what about DAX? Yeah, you got to go to global stock indices. You have S&P 500, Dow, FTSE, and the DAX, as well as Nikkei. And there's your DAX. Yeah. Looks like a good tool. Do you guys want a copy of today's report for everything? I ran a report and I just grabbed all this stuff, or most of this stuff. For example, retail versus institutional. Okay. Smart money, which is COT data, so on and so forth. The heat map. Would you like? I mean, I ran it about an hour ago and created a report. I'll just give you a copy if you want to check it out. Just download it. That's it. Literally, it's an hour old, the report, if you want a PDF version. All right, so we got to get to the news. I'm gonna zip over. Maybe I'll do pound dollar today, or Aussie dollar. Let's just quickly take a look. Okay. Okay. How do we get it? Where? You click that link I just posted. There's a discount if you want to sign up for it as well, but whatever. You don't need to sign up, pay anything if you don't want to. Okay, you can have the report. And it's today's report. So what I suspect, and it's a guess, obviously a suspect, is that we get sort of a big move up, and then in a week or two we roll over. So we could have a spike today, like we spike up, and then next week we come down and then up. Okay, Fed meeting comes out, and maybe we roll over the week of the Fed meeting or the week after the Fed meeting. Okay, that's what I'm thinking on all dollar pairs. Now for that, we're going to have a disappointing non-farm payrolls, which is good news. If the number is low, the dollar will probably weaken. Because the news is bad, it shows that what the Fed has already done is working, and the Fed won't need to do much more. So the bad news is good. Probably. I don't know the future. This is why I use long-term fundamentals and technicals. And yes, I can scalp like nobody's business, but the issue is, do I want this volatility? No, I already have all my month planned out already. I already have January and February planned out. So if I risked a lot of money and grabbed the volatility here, the spread's probably going to be wider. The slippage is more likely. I can get whipsawed and chopped up to death. And on the long run, I'll probably not make a lot of money, but I'll take a lot of risk. So I'm just like, you know what? That's not how you trade non-farm payrolls. Okay? So anyways, now if the number is good, it's plus 287,000. That's bad because what the Fed has done has not worked yet. The Fed will have to give us more medicine. Okay? So good news is bad. If the number is high, your dollar probably comes down, and you're probably going to get one of these things like pa-chow, pa-chow, pa-chow. Okay? Oh, you're talking about price ladders and stuff? Yeah, that's not a way that I trade. But even then, advice that I got, 15 years ago from a floor trader on the Chicago Board of Trade is that most of those were nonsense orders anyways, but I can't really comment. I don't trade that way. Although, ironically, we were just talking about it maybe 2 days ago. Okay? Now, I can get you a tool that can give you some price ladder stuff. Oh, has it come out already? What's the number? What's the number? What's the number? $263. Bad news, right? Does that smell bad? Smells bad, doesn't it? I don't know. We'll see. This is a buy zone for a bull, but I would expect that's a sell number. By the way, January's non-farm payrolls is going to be horrible. Oh, good. You guys knew it was going to be 200K. Well, good for you. Cool. Cool. Guess you made a lot of money then. So anyways, good news is bad. Dollar is strong. Remember, strong dollar is bad. Will it affect the USD? Florin, I just explained that for the last 5 minutes. Okay. Look at that, guys. See, good number is bad. Good number is bad. Now we're approaching the day trading profit zone. Shields up red alert. And there's another shields up red alert zone right around there. 263 is positive, and that's bad news. Yes. My pleasure, Florin. Thank you for being here. And by the way, happy number 200, everybody. Thank you for being here. I appreciate you. Let me know how it can help. I'm trying my best to give you reality, which means we gotta dilute a lot of stuff out. A lot of stuff is just not the. I think many retail traders, and it makes sense. Like, I'm not belittling a retail trader. What I'm saying is, if you're asking questions, that's good, but very often they're asking the wrong questions. So a lot of traders here might say, this should go up. The stock market should rally because, my God, we're still adding 263,000 jobs. We're going to avoid recession. That's so good. Why is the market crashing? Because you're asking the wrong questions. And if you ask the wrong questions, you're not going to get the right data. You see? Oh, and thank you, everybody. Okay, we're getting close. Okay? We're getting close, man, but how many people here liked the discussion on behavioral finance? Good is bad, and bad is good. Why is it bad? Dan the man. The good number's bad because what the Fed has done hasn't worked yet, Dan. So they're going to have to do more to kill the economy. Let me give you a horrible example, but it might make the point. How does the cancer patient feel when the doctor says, we need to do some more chemo? That's exactly what just happened. You're like, more interest rate hikes? Oh, it's bad news. Okay? Now, it's a horrible example, but it gets the point across, I hope. The good news means the Fed needs to do more and for longer periods, which means they've raised from 0 to 4%, and it's still not working. That's the problem. Okay, shields up red alert, guys. Shields up red alert. That's the projected low for the day. Can you see it? Bearish profit zone, 67.47. Alex, yeah, that's not quite right. I mean, the logic is somewhat there. You're missing a few points, but there's still wage inflation. Okay. Do you guys see that, though? 67.47. You knew that yesterday. Yesterday. Okay. Yeah, it's somewhat right. Yeah, Alex, the reason why more interest rates is coming is because more payrolls means there's more money in circulation. Nah, see, that's not what that means. But now you go from, so if there's more money in circulation, there's too much supply. Yeah, but yeah, it's not right. I know where you're going, and you'll probably get the similar result, but that's not really what it means. But what are the two types of inflation that are not going to fall next year? By the way, so I said Aussie dollar down, euro dollar down. Okay, I said gold down. Am I right? Is that what I said? I said Bitcoin down. Did I say that or did I not say that? If the number's good, gold is going to come down, Bitcoin's going to come down, the stock market's going to come down. Look at that. I went through a whole bunch. I said I have a Newtonian physics point of view because of macroeconomics. Ba-ding, bada-boom, right? Okay. Going back to the question here, what are the two types of inflation that are going to be sticky? Iris, so you say that while we buy dollar, must cry, is it? I'm not sure what you're saying, Yanni. Maybe ask again. Okay, the number one, Maida's got it. Thank you, Maida. Wages and rents. Now, the Fed tracks something called, what is it? Home HRE or something. They look at your mortgage basically and your house value, and they extrapolate what the rent would be, because in a way you're renting your house to yourself. Your house is providing you a service, and you are paying your house. You are paying, right? So there's rents and rents equivalents, owner equivalent. There's actually an acronym for it, JP, but but anyways, there's a measure of inflation on this. And then wages. Well, it's very rare that you take a wage cut, right? Your boss comes to you and like, we have to pay you 10% less. And you're like, okay. No, usually what happens is you have to leave the company and go take a job somewhere else for less money. Okay, that takes a while. I mean, it takes a long time to do employee turnover like that. It takes years. Now, what about rents? Well, the interesting thing is the government goes back and looks at leases that were signed 3 years ago. What if it's a 5-year lease? Well, then the lease isn't going to change. The rent isn't going to change for 2 more years. Do you see how slow that type of data is? How long it will take for us to get rent down and wages down? Now, the thing is, in the real world, they may be coming down much faster than the Fed can capture, or the Bureau of Labor Statistics, or whatever government agency. It might take them years to actually capture the change of inflation. So it's very, very slow, you see. And why does the Fed not use CPI? Does anybody know? Jim says it takes time, like 6 months. But in the case of rents, it could take 2 or 3 years. Again, when you do commercial property, like you're going to rent a warehouse, you might have a 10-year lease, renewable every 5 years or something, right? But you see, so it could be years before the change is captured. Steve says it's just a basket of goods. Yeah, well, so is PCE, and they do use PCE. Check this out. So I just told you how slow rents are. Okay? Rents can change, and it might take let's just say years to record the change. Rents change over years. But in CPI, rent is 30% of the basket. And yet it might take 3 years to capture falling inflation. Oh, what? Even if the Fed is doing something to lower inflation, it could take a year or 2 or 3 for rents to fall. It might take a year or 2 or 3 for wages to fall. What would make wages fall? We're losing 250,000 jobs a month, not adding 250,000 jobs a month. So how long will it take for for non-farm payrolls to go from 250,000 to negative 250,000? Well, it seems like we're a long ways off from that. So wages are not going to fall and rents are not going to fall for a very long time. One of the issues is it's not a Fed problem. Part of this was the Fed, and the Fed is fixing what they created. They created part of the problem. So they're raising interest rates from 0, which is not normal. You know what normal is? 5. We're at 4. Hey, I think they should raise interest rates to 5.5. Let's do it. Okay? So they need to raise interest rates to at least 5%. The second thing they need to do is unwind their balance sheet, but they're doing that too. $100 billion a month. So in 10 years, they will have unwound the COVID debt. Okay, great. 10 years it'll take the Fed. When the Fed is done in 10 years, there will still be a $5 trillion problem. Let me put this into perspective. $5 trillion. That's 10 years from now, after the Fed reduces all the credit they created during COVID. So the Fed is done. They fixed all their problems. There's still $5 trillion more money. Guess what? When we hit the 2008 financial crisis, we spent $1 trillion. When COVID hit, we spent $10 trillion. In 2008, the $1 trillion came from the Fed. Through quantitative easing, we had no inflation. But the Fed did $5 trillion for COVID, and the government gave $5 trillion for a total of $10 trillion. So once the Fed removes all the stimulus, if you want to call it stimulus, that they created, we're still going to have inflation, and we're still going to have too much money. Okay. Amazing, huh? Isn't it interesting? And the other point that I'm trying to make is the Fed didn't create the inflation in the first place. Alex says he thinks interest rates needs to be 9. Well, it's not the rate, it's the effect. How are we going to remove 5 trillion US dollars out of the economy? It has to happen. Or you're going to live with 4% inflation for a very, very, very long time. Very long time. We'll have 1.5% growth with 4% inflation, which means the dollar is going to be strong and emerging markets get used to being horribly poor because all your debt is going to be ridiculously expensive. It's going to be rioting in the streets in emerging markets because every penny the government makes will have to go to pay Americans for the money that Americans lent them. They're not doing it now, Mark, which is strange. So how do we destroy 5 trillion US dollars out of the economy so that inflation goes away? Yeah, Ruben, come on, man. I've covered that probably 3 times today. Hey, by the way, why don't you guys join FX Bootcamp? It's $88 a year, and you're going to learn about subjects like macroeconomics, monetary policy of central banks, scalping, spot trading, swing trading, carry trading. It's $88 a year. What's the big deal? 65, actually, I'm told it's more like 88 hours of videos. It's like $1 an hour. I mean, literally less than the cost of a textbook, but you will learn a lot about this. You will learn a lot. If what I'm talking about is something that piques your interest, you should learn this stuff. It's only $88. I priced it ridiculously cheap. You know what? Honestly, people have paid $1,000. I'm not even joking. For years, I used to sell the courses for $1,000. When COVID hit, I dropped the price to $88 as my contribution to society while people were locked up at home because I wanted them help. I wanted to offer help. It's still $88. And I can't raise the price now because my mother just got COVID. So we still have a COVID problem. All right, well, look. Okay. Anyways, let's move on.com. So the number was good. I said the dollar would get strong. I said the stock market would fall. I said Bitcoin would fall. And I said gold would fall. Hey. Nice, huh? Very nice. Oh, did I say oil would fall? Did I? I don't even remember. Did I say oil would fall? Maybe we have to rewind. I did? All right. Thank you, Alejandro. Cool. Newtonian physics. Dan the Man said, would that affect the seasonal trend? Well, it gets added to the seasonal trend. So I track the 5-year average and the 20-year average. Gloves for socks. Do you think the non-farm payrolls will actually make the Fed do 75 basis points? That's very unlikely, but let's not ask me. Listen. Look at me. I'm just some idiot on YouTube. Okay, look, I've been working with FXStreet for 20 years. All right, but still, what I'm trying to say is don't listen to me. Do your research. Do your research. My gourd. You're going to, right? Okay. Andelo's going to be a boot camper. Okay. Krister says, tell us about QuantBox. Is this a good tool? Well, look, I own the company. So what do you think I'm going to say? But I'll tell you what. Let me pull it back. Pull it back. Just download it. Check it out. Look, I don't think it's expensive. There's a free report. You can download it. It also gives you a deal. So if you want to try it, it gives you a better price. But download the free. Check it out. Dude, I think 90% of traders are going to look at it and love it at first sight. You're just going to go, oh my God, what the heck is this? Sign up. But it's going to blow your mind. Is it good? Of course it's good. Okay. Oh, Lucas has a question. Do you think the 5 trillion is actually a lot more? Good question. Okay. Lucas is saying, okay, what about the 5 trillion? Does it get multiplied? I think most of it gets spent. So, right? I think most of it gets spent, Lucas. But eventually, I guess what you're saying is, okay, and I'm going to use terminology that's going to piss people off, but I want to make a point here. When poor people spend their stimulus checks, where does it eventually go? It eventually goes to a rich person's bank account. Because they own assets like the stock market. They own Walmart stock. Or they own Walmart, okay? Or they own the bar, or they own the hotel, or they own the shipping company, the trucking company. But eventually, it comes down to 2 people in the economy. Okay? There's poor people and there are businesses. Remember, wealthy people own. They own. What do they own? Assets. What kind of assets? They own companies? They own properties? Or they own investments? Okay? Wealthy people don't have any money. Well, the interesting thing is poor people don't have any money either. Money is trash, right? Cash is trash. So people that need the money to pay their rent, to buy groceries, to pay their phone bills, well, that's what they did with it, and now the money's gone. Eventually, it works its way through the economy, and what does a wealthy person do? So, if the wealthy person eventually gets, a dividend or a distribution from their assets that they own, does it go into a bank? No, I think it gets recycled back into investment and not into a bank, because a bank could then multiply it through the money multiplier. So Lucas, it's an amazing question. Thank you for that. I even want to think about it some more, but I'm thinking, no, I think it goes into let's say another asset and not into a bank. If it's in the bank, it gets multiplied. Okay. Does anybody know the money multiplier? 1 over R plus E. Okay. Look, I'm going to give you a bit of a sales pitch here. If you join FX Bootcamp, it's $88 a year. 4 hours later, you'll be on a lesson when you do the one on central banks. 4 hours from the time you join, you could be on the lecture that teaches you how to manage the balance sheet of a commercial bank and therefore understand how the money multiplier works and the relationship between a commercial bank and the central bank. Central, I guess they're both central bank, commercial bank. So think of the knowledge I'm going to give you. 4 hours from now, you will know how to manage the balance sheet of a commercial bank. And you'll see, you will learn when you read in a newspaper that the Fed is running the printing presses. You will laugh because you will already know the Fed doesn't print money. The Fed creates credit. There's no printing press at the Fed. The Fed doesn't print money. The Treasury prints money. But even then, they don't print money anymore. The Treasury goes out and borrows money. So it's like you don't have a job, but somebody gave you a credit card. It's not money, but you can go out and buy stuff. It feels like money, but it's not. Okay? There's something different. It's credit. So anyways, the Fed didn't print this money, but the government went out, borrowed money, and then gave people money for free. So that is the problem. Okay? Anywho, what is the Treasury? Join FX Bootcamp, pay $88. You'll learn all this. I mean, come on. You need to know this. What more can I do? I'd lowered the price by 90%. What more can I do? You just need to know this. I don't care if you love me or hate me. You need to know this. You can go to, I went to Harvard. Harvard's more expensive. All right, so look. Some people are now saying, based on yesterday, okay, the number yesterday was 78. Now it's 69. So some people are now deciding there's a slightly greater chance of the Fed raising by 75 bips. Okay, it went from 78%. Well, let me reverse it. Delete. It went from it's not going to give me, I'd have to, okay, we're here. Okay, 1 day ago, it was 22%. And now it's 31% or 30%. So a lot of people say now the Fed, because of non-farm payrolls, the Fed's going to raise by 75 basis points. Now, the majority is still 70. You see? So somebody asked the question about, I don't even remember the question anymore. What do I think? And I'm like, don't listen to anybody and their opinions. I hate opinions. When I do see the talking heads behind me, when I do actually listen to the interviews, I usually get frustrated because they're giving me their opinions. I don't care. And I'm shocked most of the time. I don't think their opinions are right. So I'm trying to find the question here. What do I think? I think it was before Lucas's question. Oh, Osama said it. Why do you think it's unlikely to be 75 basis points? Okay, don't think it's not about me. This is bank to bank negotiations. Okay, what are they negotiating? Money. Boom, bum, ba-dum, boom, ba. They're lending each other money to cover the Fed funds requirements, 1 over R plus E. The money multiplier. This is the required reserves. This is the excess reserves. This is required. This is a managerial decision. So this has to do with running a bank. Okay? And banks need to lend each other money because they often have cash flow problems because they don't know, are people going to deposit a whole bunch of money tomorrow on Monday, or are people going to withdraw a whole bunch of money on Monday? Well, you don't know what people are going to do on Monday. And if you have a lot of cash, you might have too much cash and you need to deploy the cash. So what do you do with the cash? You decide to buy a bunch of bonds. But now you got a 2-year bond. So on Monday, you get a bunch of cash. Tuesday, you buy a 2-year bond. And then Wednesday, people want their cash back. And you're like, oh, whoa, what? But I took your cash and I invested into a 2-year bond. I can't sell it now. And you're like, but I want my money. It's my deposit. Give me my money. So they run into cash flow problems, and banks normally, this is totally normal, negotiate these transactions with each other. And when you look at the price, you can derive the interest rate. So that is what's important. Why do I think it's not probable that the Fed raises by 75 basis points? Oh, I don't think anything. But I can tell you it was as little as 22% yesterday, but now it's 30%. So it's slightly higher, but still quite unlikely. No. Why is it bouncing? I don't care about the bounce. Okay. Okay. Johnny's like, oh, the QuantBox AI was correct on oil. Cool. So let me show you so you don't ask somebody like me what they think. Don't ever ask that question. Okay? You should learn how you can gather the intelligence yourself. You can go all the way out a year. And interest rates are probably, right, going to be at 4.75. Okay, well, let's go to June, halfway through next year. Interest rates are probably going to be 5.25. So what did we just learn? Well, let's go to July. Look. Okay, right? 5 to 5.25 in June. Okay. 5 to 5.25 in July, but it's shifting left. Okay? By the time you get to September, look, this has dropped significantly. This 5.25 number, let's go back to June. 5.25, 36, July, 32, September, 26, November. 5.25 is only 16. 5 is only 30. And look, we could be at 4.75. What's happening here? What's happening? The Fed pauses. They pause. They cut. They cut. They cut. But really, we're at 4.75. Right? 4.75. Okay. So one way of looking at this is the Fed raises interest rates to 5.25, up to 5.25. And then they pause all summer. Then they cut in the fourth quarter once, and then they leave it there. So maybe they dial it back from 5.25 to 5, or maybe 5.25, and then they cut, they pause, they cut, and whatever. That's what's being priced in. By the way, this is facts. It's not my opinion. I derive my trading strategies from facts. I don't derive from opinions. That's why when I often listen to the talking heads on TV over here, they give opinions, and I'm like, where do they get this crap? They're just guessing. They're pulling at straws. Like, what are they talking about? That's not what's happening. You see? Oh, thank you, Richard. You see? But the thing is, this is fluid and it changes as we learn information. So you need to pay attention to this. By the way, how many other gurus give you this type of information? Whether on YouTube or on FXStreet, how many other gurus give you that type of information? Our base is none. Okay, none. None? Well, then make sure you click, if you're on YouTube, click the thumbs up button and give FXStreet some love. But in my opinion, you need to know this stuff. Okay? I'm willing to share. My macroeconomics professor at Harvard, during the day, worked at the Boston Fed as a senior economist. Then you drive over the Charles River into Cambridge. And if you guys know Harvard, you got to go across the quad to the science building. And in the lecture hall number 2, he taught macroeconomics. So we cover stuff like this. We cover JOLTS. We cover non-farm payrolls. Lots of calculus. We covered all this macroeconomic stuff. It's important. central banks, monetary policy. Okay. I'll tell you what, I paid more than $88. Cool. So this is real information derived not from opinions, but how banks are negotiating money with other banks. And they have to say, well, look, I'm lending you this money for a year, and interest rates are going to be at X rate in the future. And therefore, the value of this deal is influenced by that future expected interest rate. And so we'll price it. And they negotiate it. And they're like, no. I think rates are going to be here. And they're like, no. Rates are going to be here. And whatever. And they negotiate, okay, the contracts. Okay. What we don't know is the rate in which they do it. Clarence says, QuantBox report is awesome. I believe it's a must-have. Thank you, Clarence. No, Alex, no. In the version that I have at FX Bootcamp, there's like a macroeconomics course. It's, I think, about 20 hours long. It's very detailed. But no, I skipped the calculus. Oh, thank you, moderator. Okay. Yeah, we skipped the calculus. The most important calculus, though, is reward is a function of risk. And risk is bad. So you're going to have to earn your money in a way that minimizes risk. So anyways. So what we got to do is watch how this changes over time and how this shifts. If it shifts to the right, you're buying dollars. If it shifts to the left, you're selling dollars. You're welcome. Hey, that just happened. Make sure you, right? Give some FX Street love. Give FX Street some love. Okay, hang on. Boom, 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 boom. Hang on. I am. La 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 la. La 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 la. You know what this is? Okay. Non-farm payrolls. Labor force participation rate, 62. Little changed. People underemployed are at 3.7. Unemployed people didn't change. They're not finding jobs, but they're looking. Look at the establishment survey. This is the survey that looks at businesses. Well, Alex, try QuantBox. Right then and there. You have the algorithm gather all the data for you. It's very, very, very expensive to get all that data, but you can get all that data. And then the AI analyzes everything for you and gives you reasonable output. It's not going to do your job for you, but it'll do the fundamentals for you. And then you still have to do your technicals and trade properly. But it will do the fundamental analysis for you, and it'll do a very good job of it. There's just too much information to have to do it manually. But anyways, let's go back through this. Leisure and hospitality added 88,000 jobs. Healthcare, 45,000. Okay, lots of nurses got jobs. That's good. Government added 42,000 jobs. Construction, 20,000. Manufacturing, 14. Okay. Okay, this is what we're looking for. Average hourly earnings rose. Is that inflationary or deflationary? Can you filter instruments? Like what? Give me an example. Paul says, how can we analyze the COT report? QuantBox does it for you. You guys have a lot of QuantBox questions. All right. COT data. There it is. Okay, long dollar, short Swiss franc, risk on baskets versus risk off baskets, oil, gold. It's all here. Here's the changes in, right? Longs, changes in shorts, but here's the positioning. I like to compare them. Okay, retail traders versus institutional traders. Okay. Look at that, huh? And of course, what you want to look for is the extremes and say, I don't like the terminology, dumb money versus smart money. But you probably want to look here first and say, all right, retail is heavily short, so I need to go into those charts and see if I can get a buy. And here retail is heavily long, so I want to go into those charts and see if I can get short. It's for stop hunting. The difference isn't smart versus dumb, it's long-term versus short-term. You see that? No, Alex, this does not do earnings reports for major companies. This is macroeconomics, not microeconomics. So sign up here and you'll save some money. But that's it. So I'm not sure what you were saying about filtering, but like, right, going through the COT data is pretty easy. You can see, again, right on the dashboard, we put it here. Right? And then here's the trends, so you can get all bullish trends if you want. Here's all the bullish trends. Here's all the bearish trends. Okay? So you can go and check out like the 10-year T-note, for example. Okay? Which means the bond market's rallying as interest rates are falling. Or yields, sorry, yields. Yields are falling. Okay? Nice, right? It's pretty, isn't it? So here's the strong buy and all the other buys. Everything else is neutral. Here's a few sells and a few strong sells. Cool. That's it. That's all you need to know. Boom, 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 boom. The AI does everything for you. It gathers all the data. And again, like I said, what data does it gather to make this information? It's looking at interest rate differentials, employment differentials, inflation differentials, GDP differentials, the technical trends. It's actually analyzing technical analysis and projecting 7 days in advance and scoring it. It looks at seasonality, 5 and 20 years out. It's looking at retail positioning. It's looking at institutional positioning. It scores it all and it says, yeah, it's going up, but it probably should be going down. So it's neutral. But I'll tell you what, as soon as the technical trend turns bearish, QuantBox is going to push this to a sell or a strong sell. Oh my God. Oh, I'm telling you. Oh, you know it's true. Regil says developers are expensive too. Well, ones that know economics, gold is in there, not silver, J-Man. Although, you know, maybe one day I'll add silver. But it's under commodities. Okay. So you probably have been buying it for a while. Yeah. All right, cool. See, here's the thing. Seasonality. You can see around the end of September, you should expect gold to start rising. Oh, it did. Of course it did. It's supposed to. But you knew that 6 months ago, didn't you? Charlie, if you can't read the charts and make the decisions yourself, then you shouldn't buy it. No, it does not give you alerts. It's not how it works. It's not going to do your job. You have to be smart enough to know, because think of it this way, Charlie. Many of these, right? Many of the pairs are neutral. Well, let's pick one that's a hard sell. In a hard sell scenario, you open your chart, but it might not be a hard sell today. Do you understand? So you need to be smart enough to say, well, I'm bearish. I'm very bearish on whatever it is. Let's say the stock market. You're very bearish on the S&P 500. Well, then you go over to your S&P 500 chart, and let's say you look at it, and it's not a bearish setup. It's bullish. So a dummy will sell it because QuantBox says to sell it. You should just quit trading. Honestly, if that's what you're expecting, you should just, I mean, look, you're looking for the wrong thing. I would say, look, if you got $5 million, give me a call. Maybe I'll trade your money for you. But if you got less than $5 million, forget it. You should just stop trading. QuantBox is not going to do your job. It's not going to make you filthy, stinking rich. By the way, I'm not saying that's what you said, but I am trying to make a point. Okay, Charlie? No, it doesn't send alerts. It does. Here's what it does. Quantitative analysis. But it's more than a tool. If you were at a hedge fund, you could hire somebody for $150,000 a year to do this for you. That's it. Okay? Dennis, AI is important, but it doesn't do the work. Is all I can say. Okay? So anyways, it will quantitatively gather the intelligence and score it and tell you what it means. But then you can go to the chart and see something a little bit different. But like, what would you do, let's say, what would you do if, what would you do if QuantBox said you're a bear on the S&P 500? You'd be a fool to sell here. Fool. Why would you be a fool to sell here? Because you're at support. What's wrong with you? You're selling at support? It's ridiculous. But quantitatively, it should fall. If that's what it says, that's what it says. So if you're a bear, fundamentally, based on quantitative analysis, then what should you do if you're a trader listening to your quant? Remember, the quant isn't wrong, but you're the trader. So if you sold here as a trader, you'd be wrong. But your quant is still right. Wait for the bearish setup. Like what? Like, how about this? How about we take the old lower low, drag it across? How does that smell? What do you think? Okay. So could this be your plan then? You would have to be smart enough and skilled enough for QuantBox to say strong sell. And then you go to your chart, find yourself here and not sell. What kind of trader sells at support? A broke trader. A broke ass trader. Well, the QuantBox told me to sell it. Just quit. Okay? Or smarten up. One of the two. Okay? Yeah, bat. You're either a bull, a bear, or a bat. Okay? Forex, Kobar, it's, yes, it's for strategy so that I can tell you what I'm going to do in January and February. I could say in February, I'm going to be short pound dollar. And you might say, why? And I can give you like an overload of information. How many people here saw me do the FXstreet interview several years ago where I'm in a three-piece suit on my way to meet with a central bank? And I outline week by week my trading strategy in the near future. So I think it was the end of December. And I'm like, oh, well, it's going to fall for 3 weeks. Then we're going to be in the third week of January. Then it's going to rally up. And then, but it's going to be a false rally. Then I'm going to take it down. And then I'm going to do this. And then I'm going to do that. And then I said, but to preface all that, I said, the weirdest thing is I'm long right now on everything. And it might be today, it might be tomorrow, but I'm going to dump all those positions, reverse everything, and do the exact opposite over the next 12 weeks, and explained why. And guess what? Oh my God. I seem to recall it happening almost perfectly. But I could just babble in the middle of an interview outlining what's going to happen over the next 12 weeks. Within reasonable accuracy, right? Within what, 90% accuracy? Hey, moderator, are you able to find that one? The interview guy, he's good. Is it Russ? Is it Russ? And I think he was in like Belize or Guatemala or something. Which website? I have many. I'm a man of many means. If you're looking at QuantBox, a lot of people are asking about QuantBox, so I'll give you that one. Ross. Do you know if it's on YouTube or on FXStreet's website? Ross. I'll search for Ross. Berlin. Play all forecast. Oh, here it is. Oh, I think it's here. Yeah, here it is.
Here from FX Street, and I'm joined today by Wayne. Wayne, you've made a special arrangement to be with us this morning, so thank you very, very much. The idea is to give our audience today a feel for 20. I shouldn't be too much of a stranger. My background is I was a high-tech entrepreneur. Got my way up.
Yes, that's a volcano. So you have to find it somewhere in here.
About supply and demand of currencies on the short run, as far as when this is all good. It's just human nature. So if they freak out in December, my charts will tell me. If they can hang on till January, then I'm going to expect the yen strength, and when I see it, I'm going to buy yen. But here's the thing, and you bring up a good point. Dollar's probably still going to be strong because the fundamentals haven't changed.
Ha ha ha! Oui, that's pretty good. Huh? Man, when you're in a third world country wearing a $1,000 suit, you look like a boss, don't you? Have you ever seen Monty Python? One peasant says to the other, I think he's the... Oh, that must be the king. The other one peasant says, why do you think he's the king? He's like, he's the only person without shit all over him. I'm wearing a wool suit. I'm wearing a wool suit and there's a volcano behind me. Anyways, funny. So anyways, yeah, I go through it week by week by week. I'm doing this now, but I'm about to do that. And here's why, and here's how long. And literally I go, it'll be down for 3 weeks, then up for 2 weeks, but that's a false rally. Then it'll be down for yeah. Cool, right? Oh, you found part of it over there. All right, cool. Awesome. I didn't catch that. So anyways, there's the links. Very cool. Which is, all I'm trying to say is, Nothing has changed. And I said this in the article that I wrote last week. Nothing has really changed in the 200 months that I've been teaching via Trade Non-Farm Payrolls Live webinar. I want you to be conservative. I want you to be disciplined. I want you to be independent. I want you to know why things are happening because you have research and data to back up your bias. So then when you go to your charts, you already know if you're a bull or a bear and why. And you're thinking, oh, look at this big rally in the SP 500. Oh, that's great. I think I'll sell it soon. So you know somewhere, kind of where we are now. If it rolls over, and so now you might want to use a smaller time frame. If it rolls over to the downside, you want to get short. Nice. And some retail trader, he's thinking, or she, oh, we double bottomed off of support. Dude, that was the number I called out. Anyways, on the other, anyways. And then it goes up. Someone's going to buy it, right? Yeah, they're going to buy high at resistance. Wah, wah, wah. Huh? That's not how you do it, huh? Maybe it was euro dollar. Was it euro dollar or pound dollar? It might have been Aussie dollar. Let me go back to the dollar pairs. Oh, no. It was Aussie. Okay. How many people here remember me talking about 67.47? How many people here remember it was a solid red candle? And I'm like, 67.47. We knew that on Thursday. Anybody remember? Yes, Alex. Look at Alex asking the tough questions. That's rude, Alex. How do we know it's right? Alex, how rude, making me look bad in front of everybody. All right. Yeah, that would be good information, wouldn't it? Oh! Yeah. The answer is correct. Okay. So it said strong buy, medium buy, medium buy, medium buy, buy, neutral, buy, 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 buy. And it went up. Yep. Yeah, okay, so that worked pretty good. You want to look at, what do you want to do, EuroCAD? Okay. This says sell, and that one didn't work. That's why you need to do your job. Where if you still need to know how to trade. So let's look at what went wrong potentially on that. So let's look at the chart. So that's EuroCAD. I got to go to my crosses, EuroCAD. Okay. Right now it's neutral. So that whole time it might have been more neutral than anything. And what did it say? Yeah, you can see some of the data is favoring euro. Some of the data is favoring CAD. And it's not much of anything. It gets a score of 1, isn't very good. So that's probably what we see in the back test there, where it wasn't actually sell. It was more like neutral, 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 neutral. Okay. Okay. So you would do something like, on the dashboard, for example, it says you should look at buying these things and selling these things. Okay. So you're like, oh, I wonder about Euro Kiwi. So you're like, oh, let's look at Euro Kiwi. Yeah. Retail 70% long. Okay. What does it say in English? Euro Kiwi currently has a score of -7 or strong sell rating after adding up all the categories. First, let's look at what institutional traders are buying and selling. We can see that the euro has a long percentage of 67%, and we see that the Kiwi has a long percentage of 44%. This category receives a +1 as institutional traders favor the euro. Taking a look at Euro Kiwi, we see that retail traders are 71% long and 29% short. We consider this information most useful when the market is an extreme reading from retail traders. If the retail crowd is 60% or more positioned to one side, we give it a +1 or -1. Currently, the Euro Kiwi gets a reading of -1 in this category. Remember, if the retail crowd is very long, we look to short, and vice versa. Taking a look at seasonality, we get a score of -1. What this tells us is based on the historical data, this market tends to fall during this month. Trend reading is based on the daily chart using the 5, 8, and 21 exponential moving averages. This is the more aligned they are, the stronger the trend up or down. In this case, we have a score of -2. Finally, let's look at fundamentals. GDP growth favors the Kiwi, inflation favors the Kiwi, unemployment favors the Kiwi, and interest rates favor the Kiwi. Strong sell. So now what would your job be? This is a daily chart. We're doing predictions 7 days in the future. We could drop as low as 162. So what's your job now with Euro Kiwi? Of course, I don't have a Euro Kiwi, or maybe it's over here. No, I have Noki instead on this one. Okay, so let's change this. Euro Kiwi. Remember, you're a bear. So you're filtering your brain. Is this a good price to sell? Not really. Where would you sell if you were you? All right, well, if I were me, there's a few different places I want to look. Okay, I probably want to sell off that 21 in the future. Okay, but do we want to sell on a double bottom on a monthly pivot? No, probably not. So somewhere in the future, we probably want it to go a little bit higher and then take it down. Now, technically speaking, right, Monday's short zone, okay, Monday's short zone is 164.74. So you could try, this is the short-term trade. Okay, the longer-term trade is probably going to look more like this. Down, okay, up, and then a down. So now you have plan A. This is plan A, and this is plan B. And that's how you do it, son. So Rayhan says, sir, do you think Euro Kiwi will go up? There's no technical or fundamental reason for it in the moment. I would never even consider it. I would either sell here, which is just a day trade. This is a swing trade. and we're probably already on the monthly trade. So think of it this way. There's a period you can see where Euro Kiwi was rising. So if you join FX Bootcamp, hint, hint, wink, wink, nudge, nudge, you would already know that this is the December sell zone. You already should know that because you know how to trade. What QuantBox says is it gathers. Think of how hard it is just to gather all that data. Seasonality. That costs $50 a month just on that. COT data, institutional positioning, retail positioning, jobs, inflation, interest rates, growth. Okay? Putting them all together for 30 asset classes and then comparing them all. And then doing technical analysis and 7-day projections and then adding that. Oh my God. But so the thing is, as it's rising, you were waiting to sell. So now that you show up here, you're like, Wayne, should I sell it now? Well, you know what? You're about 4 or 5 days late. So don't be shocked if it does this first. Right? Tech Revolution TV says, does 263 make the dollar bullish? Yes, and I discussed it for an hour before it came out. Yeah. Okay? Yeah. Okay? Growth? You want to buy growth stocks? Osamu, you want to buy growth stocks? Pass. Oh my God. I think you're going to be disappointed next year. Pass. Not interested. Oh my God. Oh my God. Yeah. Gold. You want to look at gold? By the way, I'll say it again. I ran the report this morning. I have all of this. I've gathered most of the data here on all of this quant box. You can have the whole report. I've already, right? Right? Where's the page? Where's the page? The pages. Oh, here it is. Look, you can just download it. Here it is. Oops. Just take it. What about gold? Just download it. Gold is on there. It'll tell you. It'll give you all the information you want about gold. Take it. It's yours. Compliments of the firm. Okay. Okay. Just take it. You don't have to ask me. It's yours. Just download it. Okay. Yesterday. Okay. Rayhan says, sir, I'm in an Aussie Kiwi buy. What could happen next? Well, quantitatively, you couldn't pick a dumber trade. So I think you have a strategy of picking bottoms. And let me tell you, picking bottoms is a strategy that always stinks. Yeah, you couldn't have picked a worse trade. Sorry. Now, let's look at it maybe, let's break this down slightly differently. Yeah, I don't understand you. I don't understand anything that you're doing. I'm looking at charts. There is absolutely zero reason to be along that. Just technically. But of course, fundamentally, it doesn't make any sense either. QuantBox shows you that. But even technically, I have no idea why the heck you would buy that. So you have me at a loss. I really, honestly, and I'm not trying to like make you feel bad. I don't get it. Okay. Yeah, we get, yeah, J-Man. Is it J-Man or Jag? Let's go to commodities here. Yesterday. Oh, hang on. I got to stretch. Did I show you? I got the cufflinks on today. Oh, I don't know if you can see that. Anyways, got the cufflinks on again. Noise. And by the way, look at bullish. That's a bull. Dollar. And the dollar's strong today. Oh. Okay. So anyways, let's go to commodities. We can look at Biddy. Okay. Yesterday. Okay. There's Bitcoin. You see what I'm doing here? There's the price ladder. Those are the orders. 75. See, there's big orders up there. 113, 5, 5, 113, 1, 5, 1, 1, 3, 1, 5, 1, 3, 9, 6, 3, 5. Boop, 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 boop. 10, 59. Look at that. 59 lots. Oh, down to 1.5. 70 lots. 70 lots. 66 lots. Getting filled. Anywho, that's a nice tool, huh? That's available free at tradersway.com. Wink, wink, nudge, nudge. Remember, they're an ECN with straight-through processing. Beautiful. Nobody trading against you. All right, so we can use this and say, not up. Okay. Okay. But we're not quite bearish either, because we got to get through this. Okay. So you could be a bull here if you wanted to be. I think you're early. I think you'd be early, but you might have a trade for it. Now, what about other cryptocurrencies, right? Uniswap, Dogecoin, Solana, Polygon, Polkadot, okay, Avalanche, Cardano. So what did you ask me? Who asked about crypto? What did you want to look? Oh. Ooh, 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 ooh. Yeah, I don't have anything set up at the moment to just random jump right in. Here it is. Okay. But yeah, I'm happy to cover it for you. So it should be down according to non-farm payrolls because the numbers were good. Okay. Technically, we have a slope here, but we're not lower, very similar to Bitcoin. I wouldn't get aggressive unless we go to the bottom of the channel, up, through, up, and like this. Okay. So we have to work through all of this. And then there's probably a bunch of buy orders down here that we need to work through as well. Oops, probably in here, right? We need to work through buyers if it's going to go lower. Okay. Okay, we could look a little further out if you want. You can see we hit the November target. You see? So when you join FX Bootcamp, are you going to join? $88. Come on. When you join FX Bootcamp, you know that this means take profit here. That's it. You should already know that. So you're like, oh, well, that totally makes sense. Yeah, it does totally make sense. All right. So you think another move down? I don't think in December, but maybe in January. So if I were to now guess a little bit, I would think up to 1,500 and then down below 1,000. Oh, don't say it so, Wayne. I don't want it to go to 1,000. Well, it's going to go to 900. Okay. And if the stock market crashes in January, my God, we're going lower than 900. But it can't do that. I'll have to sell my yellow Lambo. Oh, well, you should sell at the top. J-Man says 1,500 would be the peak. I don't know the future. I don't know. I'm just telling you what the chart says. Okay? So, if you hired me to be your fund manager, so you're like, Wayne, I got 10 million bucks. I want you to manage it for me. Cool. And I say, so what do you want to do? And you're like, well, I want to dump Ethereum. Oh, cool. We can do that. Plan A is here. Plan B is here. Cool. Nice. Alex says, or 500. Yeah, I'm not there yet, though. We're not there. We're not in those conditions yet. So I can't make the prediction because the prediction is just a guess. Well, I don't guess. I don't have opinions and I don't guess. I'm a lumberjack and I'm okay. Sleep all night and I work all day. Okay. So right now you're like, well, Wayne, what does this chart say if you're a bear? Oh, if you're a bear, I'm going to try to sell around here and I'm going to give another effort around there. And after that, I'm going to stop if it goes higher. So I'll probably have 2 trades in there. And then if B works, then I'll probably do another one on C. So let's say A, I sell. Okay, I take a loss. I sell. I sell. I sell. And my target is 888. Now, if plan A does work, okay, that's plan A, then I can scrap plan B because plan A worked and my target is 750. Okay, sell at 1380, going for 740. It's actually 740.7. Oh, nice. Okay, question. Why did I laugh at NASDAQ? Okay. All right. Well, let's talk about that. Delete. The expected return of a stock is equal to the risk-free rate of return plus the beta times, what is it? The expected return for the market minus the risk-free rate of return. Right? Okay, Osamu? Higher volatility. Okay, higher beta. Okay, the other thing that and I think this is a lot of what's already happened. The second thing that you need to do is the present value of a stock. Okay. The present value is equal to, the future cash flow of the stock over 1 plus, I'll put the risk-free rate of return, times 1 plus future cash flows of the company over 1 plus the risk-free rate of return over 2 plus future cash flows over 1 plus the risk-free rate of return over 3. And this will be for, let's say, 22, 23, and 24. So you can look at, you're going to have to guess where the Fed funds rate is going to be this year, next year, and the year after. That's why we use the Fed funds futures market to analyze that. You want to look at the beta of the NASDAQ. Beta is higher. Cash flows of NASDAQ companies are lower. Okay. So you have falling cash flows next year, right? For sure, because they're even going through layoffs. So lower cash flows, higher beta, okay? Higher risk-free rate of return. And what this means is the value of the stock is down. The present value of the future cash flows will fall. This is stage 1 of the economy. This is, right, of the recession. This is stage 2 of the recession. And stage 2 is going to start happening in the first and then second quarter of 2023. What do you think? Osamo, you still with me? Let me ask you guys, because I don't know, how many other gurus can do the math? How many gurus outline the math behind anything? The market, the math behind their technical indicators. How often do you get the math written out in explicit detail? I hope you appreciate that I can do the math. Look, we also did the math. Do you remember we did the money multiplier? Where we can go over the required reserve ratio of the Fed and do the math and explain how it impacts the quantity of money and therefore the value of money. Okay. Huh? That's nice, right? Yeah. Good. Look, I'm an only child. I love to feel special. I love to feel special. That's why I try so hard to please you. Well, that was from the falling down the stairs situation, Jim. That's okay. I got kicked by a mule and fixed that problem. Okay, so anywho, you guys want to do some more math? Nah. All right, so look. If you are a bull, you're in the buy zone. You see this? So if you want to buy it, now you're on this chart. Well, the math is the same. It's just technical analysis, right? And the value, I mean, I'm sure you could look up the beta of Ethereum. mean, you'd have to really think about it, right? So what you're talking about is you're not analyzing the stock fundamentally through cash flow analysis. Okay, so you're not doing cash flow. So you would write it this way. The expected return of Ethereum, right, is equal to, I'll get rid of this, the risk-free rate of return, which is the yield on the 10-year T-note. So we'll just say 0.04 plus the beta. Okay, you got to find the beta for Ethereum. Okay, and then you need the market. What market are you going to compare? What's the volatility? That's all beta is. What's the volatility of Ethereum compared to the S&P 500? Is that what you're going to use? Or is there some sort of crypto number we can put in here? Okay. So you have to know like what market. And again, why do we care about the risk-free rate of return? That's opportunity cost. So again, that would be minus 0.04 because you have to think about this. This is what you expect Ethereum to do relative to the volatility of Ethereum, relative to the market, and your return in the market relative to your opportunities. So if you thought the stock market was going to be negative 10%, okay, then you got to throw in your opportunity where you could have just earned 4%. Okay? Or if you earned 10%, you have to subtract what you could have earned. By taking no risk, you could have earned 0.04. So your actual return was 0.6. You see, like this is what you're calculating. Okay. So anywho, risk-free rate of return typically is the yield on the 10-year T-note. If I was doing expected return of Apple, I'd have to say, what is the volatility of Apple relative to the market, the stock market, the S&P 500? And that's something you can just look up. It's just a number. So if for example, the S&P 500 was down 1% today, but whatever we're analyzing, let's say Ethereum is down, is down 2% today. Then you can see that there's a lot of volatility in Ethereum relative to the S&P 500. So, for example, if you expected the stock market to be up 1%, you would expect Ethereum to be up 2%. Okay? No, but Alex, you're now doing an asset versus an asset, and that's not what we're doing. Okay? You wouldn't do one asset versus another one. It's a single asset versus a market. Okay? So you could probably find the beta of Ethereum relative to the S&P 500. So you just look that up and it's a number. So, right, it's either a high number or a low number. Lots of volatility. Okay. You can also have inverse volatility. If the stock market is down 1%, you could have a scenario where in situations where the stock market is falling, an asset could actually rise. So that, right? So you have to know this stuff, right? So anyway, so you just plug it in and it spits out a number and it tells you the expected return for Ethereum. But you have to look at how the markets are moving. And the markets move on how attractive the alternative investment is, which is like, why would you buy stocks if you thought stocks were going to fall by 10% when you could just buy bonds and earn 4% interest? Plus, by the way, that's just the interest. That's the risk-free rate of return. But if the stock market falls, the bond market's likely to rally, and the value of your bond, not only does your bond pay you 4%, the price of the bond has gone up, and you could sell it for probably 20% profit. So that's why the risk-free rate of return, your opportunity cost, matters. Of course, what the market's doing matters, and then the volatility of your stock relative to the market matters if you're trying to find out the value of Ethereum or your stock or whatever it is. Okay? This is just finance, guys. You can do it for anything you want. It's just money. Cool. Of course, Alex. What do you think I cover in 80? There's something like 88 hours now. 88 hours. It's like taking 3 or 4 college courses on Forex. I mean, it's no joke. Redonkulous. Okay. All right. So anyway, so if you're a bull, you would be sitting around waiting for an opportunity to buy here because we're at a level which might act as support. Okay. Bears are selling off the ribbon, of course, but the timing might be a little too early. It might need to rise a little bit more before it falls. So you kind of need bulls to buy it so you can sell it. Okay, so there's that ribbon. Let me clean this up. I don't know if I actually saved this template or not. So let me clean it up, and then then I'll destroy it. Delete. 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 Almost there. Hang on. Be patient. Okay. Template. Save template. No. All right. So we can change this a little bit. Okay, looking further out on the daily. Okay, so what I'm pointing out is if you're a bull, we're in this zone here, that could be bullish. You understand that? Yeah. Take a look at this from a different point of view. Okay. In January, the predicted high for gold this year was $2,028.60. You knew that, right? You knew that in December last year. How nice is that? The projected low was $1,603.40. Oh, but Wayne, it only went down to $1,625. Oh, yeah, sorry. Yeah, full Monty, eh? So, currently, if you were a bear on gold because you thought the stock market was going to fall next year, gold is going to fall to $1,471.60. Wow. Isn't it nice to know the future? Hey, Raymond, what percentage of South Africans were shocked and in awe that government officials were stealing money? Yeah, better mind and grow. Although I would like to come visit. Check that out, huh? None. Yeah, that's what I said. I was chuckling about it earlier. I'm like, really? Oh my God. Yeah. Alex, the Fed officials used to trade with insider information. I think in South Africa, they literally walk over to the bank and take money out and give it to themselves. Okay. Oh, Chico says gold is going to 1935. 1935? Maybe. We're not done December yet, obviously. So right now I have 1927, which is pretty close to your 1935. And then that would be a sell. Yeah, okay. What do you think of that, Chico? What do you think of something like this? Yeah, hey, it happens, Raymond. $25. Oh, silver? It's so funny. Technical analysis is funny. Like your guy's like, well, what about this and what about that? You're asking like, and that's why like you got to learn some technical analysis, but it's not complicated, right? You're asking me to recite the ABCs. Well, can you do it if you start at N? O, P, Q, R, S, T, U, V, W, X, Y, Z. What if you start at E? F, G, H, I, J, K, L, M, N, O, P, Q, R, S, T, U, V, W, X, Y, Z. Can you say it backwards? Z, Y, X. You know, like, what? Silver? Okay, let's do silver. XAG, man. XAG. Okay. What does it say? Well, let's take the same narrative and do it that way. So we have not set December yet. So let's put December up because of seasonality. Currently, it's 24.77, so let's say 25. And the projected low is somewhere between 15 and 13. Okay. Now, Jose says, heading to 1741, I know what you're saying. You're not predicting the future. You're saying, yeah, down to support. Well, you're missing trend. And trend is indicating something different. You ready? Let's do some calculus. Let's do some stats. Okay? Quadrant 1, 2, 3, and 4. First thing you need to do is analyze the data set. This candle, this candle, this candle, this candle. And plot the average price. Okay? Oh, I wanted that to be black. Sorry, let me redo it. The average price in the data set. Okay? So we call that the mean. There's quadrants. Here's the mean. You ready for it? There's X and Y axes. Y is equal to MX plus B. Hang on. Excuse me. All right. Y equals MX plus B. M is equal to the rise over the run of the mean. Because we're looking at slope. What's the trend? So, rise over run is negative. So this is bearish. Then we want to look at overbought and oversold conditions. How do we do that? We calculate the mean, and then we calculate variance. Variance, 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 variance. How far does price move away from that mean? So we call this variance. And then we want to calculate standard deviation. Okay, standard deviation, which represents 95% of price action. Standard deviation is equal to the square root of the variance. And it gets you up in this situation here where when price tends to get this far from the mean, it tends to revert back to the mean. When price is this far below the mean, price tends to revert back to the mean. Okay? And the Y and the X are simply the axes, and the B is the intercept. Okay? So what I'm saying is there is a trend here. So I would agree with, who said it? Jose says 1741. Okay, great. But if you extend to the future now, extend to the future, future, which is what I'm trying to do. I'm trying to teach you how to predict the future. Quantitatively, statistically, mathematically, qualitatively, right? And what that gets you to, okay, Jose, if you're right that it's going down, then I would say you're cutting yourself short at 17. This is much more likely to be somewhere between 15 and 13, because it probably would do down, 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 out. Okay. Okay. La la la. La 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 la. Okay. Do 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 do. Oh, I believe. Okay. You see? Do do do. Do 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 do. Huh? Isn't that nice? Jose, I think you're worth more. And that's it. It's 10:31. You spent 3 hours of your life with me. What's wrong with you? Oh, hey, happy 200. Thank you to FX Street. All the leadership that's helped me over these years. Thank you to Francesca, who worked with me back in developing Trade Non-Farm Payrolls Live #1. It's been 16 and a half years, and I'm honored to serve you. I'm a servant, and I thank you for everything that you contribute to this community at FX Street, to my community at FX Bootcamp. I appreciate everything that you do. Again, I invite you to join FX Bootcamp. It's $88 a year. You don't need a coupon code. Okay? Are you guys going to join or subscribe to QuantBox? You going to do it or what? I have amazing news to tell you, but I can't tell you today. So if you like QuantBox, get involved. I'm telling you. You're going to regret if you don't, because some amazing things are about to happen. So thank you to our moderator. We have the world's greatest moderator. Moderators look up to our moderator. They sit and say, I wish I could moderate. This is extreme moderation. There's nothing moderate about our moderator. Better moderation than Twitter. So again, thank you to our moderator. Everything fantastic. Thank you to FX Street for hosting me for 200 years. It's been a real honor and a real pleasure. Think of it, guys. 600 hours of doing this one thing we call non-farm payrolls. Pretty soon I might become an expert, but I see myself as a student. So I'm still learning. I'm still challenging myself. I'm still open-minded, but I'm a stubborn person, and my trading hasn't changed. But maybe the tools and the analysis and the process has improved. But the way to trade is always the same. That's why I was able to show you the slide deck from Trade Non-Farm Payrolls 16 and a half years ago. And the mantras are still the same. Capital preservation, right? Capital acquisition, capital appreciation. Don't do something stupid and get yourself killed is always the #1 goal. So I hope in some way the knowledge I share is helpful. I hope in some ways the energy that I share is inspirational. I've been doing this for 20 years and I'm still passionate. I'm still inquisitive. And I hope you are 20 years from now as well. And that's it. I'll be around. I'm around. I'm easy to get a hold of. I'm in the world. So I hope to see you again soon. Maybe visit tradersway.com and open an account with them if you need an ECN with straight through processing. They pay high spreads. High swaps. Their spreads are very competitive and their execution speed is faster than most. You can do your third-party research. You'll find out Traders Way is faster than most. You're like, dude, check them out, tradersway.com. And with that, peace on earth. May the pips be with you. May your profits be... Well, you know what? Wait. We should do this properly. There we go. Now I can see you. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day. Have a wonderful weekend. See you again soon.